the extension entry method, and we've also talked about this a bit throughout the course, but now let's go ahead and get into some details about it. This is a simple entry method we use to increase the reward to risk on higher time frame patterns. Again, obviously we also just showed how we use it to qualify a divergence setup if it is a three-wave cycle. We use this entry method when using the smaller degree time frames to enter into larger degree price patterns. First, we isolate a level of support or resistance on the higher degree time frame. Once price moves into that level, we watch for price to react by creating an ABC or a 1, 2, 3, where the C or three-wave extends to the 162% Fibonacci projection of AB or 1, 2. We enter as soon as the 162 level is hit. We place our stop below the low of A or 1, and our target is the target range of the higher degree pattern, usually the 100% to 127% zone. Let's go ahead and show some examples of this on a price chart. Okay, so in this example, price has come down to a level of daily support. This is our 15-minute chart. With an extension setup, we look for price to come into that support level and then create this pattern. And what you see is price, and let me just make sure that, yep, here's the low. We have the rally, okay, the pullback, and this leg. So we have an ABC or 1, 2, 3, where the C or the three-wave extends to the 162% projection. So we measure from the bottom to the top, pull it back to the bottom of this second or B wave. Once price extends, this is where we enter. Now remember, we're using a 15-minute chart to enter a pattern on potentially the daily time frame or the 4-hour time frame. Okay, so we're trading for the larger degree targets. Our stop loss needs to go below this low, and we target the higher degree time frame targets. Okay, that's pretty simple. That's an extension setup. Okay, then obviously we would manage the trade if price started to move in our direction. Okay, we would manage the trade as price moved. We would use key swing points. Okay, so once price started to rally, we could if we're looking at a daily support or a daily pattern, and we drill down to the 15-minute, and if we're looking at a daily support, we could probably use an hourly setup like this. But we would want to use swing points, key levels, levels where patterns would no longer be valid, so we can look at the hourly chart and move our stop and reduce risk, remove risk, and lock in profits from those degrees. But we would certainly want to manage the trades very well using these smaller degree time frames to enter on the higher degree time frame patterns, because our reward to risk ratios are going to be very good. Okay, now in this example, you can see this level of daily resistance. All right, this is the daily chart. Here's where the market made a high. We came back up and we retested this high right here. All right, let's go down to the hourly chart. Here is the same level on the hourly chart. Okay, this is that same daily level, and let's look and see what happens. Look at how price measured down to the low, to the high. Obviously, we have a solid extension set up here. Okay, so our entry would have been right here at the 1618, stop above the high, and we could target the daily target levels. Okay, and you can see obviously we had quite a bit of downside movement to go after testing that daily resistance. Okay, and you'll see this type of setup a lot in the market, and one of the things we use this setup for as well is to basically project the next cycle. So if we see the extension, it helps us to project the next coming cycle. And we talked about that a little bit earlier when we talked about doubles and triples and the ABC patterns. You can even see it again right here with the larger pattern right here. If we measure from our high to this low point, here's a three-wave cycle, to the low point, pull it back right here to the corrective cycle, and then look at this three-wave cycle, see how it extended to the 162%. And then look what happened. We pulled back. We would have maintained a bearish view here. We had a pullback and a continued move to the downside for another cycle. All right, now let's just go ahead and measure that cycle from the low, pull this back, and that is equal legs. Okay, so we had an extension in our third wave, or our C wave in this case. We would have labeled this as a W, X, and then this part of the double targeted equal legs. So the extension gave us the probability of the double, sell the pullback, equal legs to the downside. So you can kind of see how everything here works together with these patterns. Okay, so that's the 162% extension, otherwise known as a bullish extension or a bearish extension, or just the extension entry method.